You probably learned that if you work hard, save money, and pay your taxes, you'll build wealth. But no one told you that two people can earn the exact same income and pay vastly different amounts in taxes. Not because one person is cheating the system, but because one person understands how the system actually works. Today, we are breaking that down. No jargon, no fluff. Just the 5 most powerful tax strategies used to legally build and protect wealth. Strategies that are hiding in plain sight inside the U.S. tax code. Let's get into it. Myth. Taxes are about how much you make. Most people walk around believing that the more you earn, the more you pay. End of story. That belief keeps millions of people stuck. Because here is the truth. The tax code is not designed to punish income. It is designed to reward behavior. Behavior like starting businesses, investing in assets, creating jobs. The wealthy do not pay less because they earn more. They pay less because they structure differently. And structure is learnable. Strategion. Your business entity is your first tax decision. If you are an employee, a W-2 worker, your taxes are deducted before you even see your money. You get paid after the government takes its cut, full stop. But if you operate as a business, an LLC, an S-corp, a sole proprietor, the math works in reverse. Your business earns revenue, it pays its expenses, and only what remains after those legitimate business expenses gets taxed. That is not a loophole. That is how the code was written. On purpose. When you structure as a business, you unlock the ability to deduct the costs of running that business before calculating your taxable income. And that single difference is responsible for some of the most dramatic tax savings available to everyday Americans. Strategy 2. Deductions are not cheating. They are instructions. Let us say a business brings in $200,000 in revenue. If it spends $80,000 on legitimate business expenses, software, home office, professional development, equipment, business travel, health insurance for the self-employed, the taxable income drops to $120,000. That is $80,000 the government never sees. Not because of some clever accounting trick, but because Congress literally wrote those rules to incentivize business activity. Now compare that to an employee earning the same $200,000. Their deduction options are severely limited. They pay tax on nearly the full amount. The difference is not income. The difference is structure. Strategy. 3. Not all income is taxed the same. And this is everything. Here is one of the most underused pieces of financial knowledge in America. When you earn a salary, you pay ordinary income tax rates, which can reach 37% at higher income levels. But when you hold an investment, stocks, index funds, real estate, for more than 1 year and then sell it, that profit is taxed at the long-term capital gains rate. Depending on your income, that rate could be 0%, or 15%, or 20%. Think about that. A person earning $50,000 from a job could pay a higher effective tax rate than someone who made $300,000 from long-term investments. This is why the wealthy are obsessed with transitioning from income to assets. Income is taxed aggressively. Assets are taxed strategically. Strategy 4. Real estate creates paper. Losses that are very real tax savings. Real estate is one of the most powerful legal tax strategies ever built into the U.S. tax code, and it works through a concept called depreciation. Here is how it works. When you own a rental property, the IRS allows you to write off a portion of the building's value every single year, because buildings wear down over time. This is called a depreciation deduction. The wild part? The property might actually be increasing in real market value. But on paper, for tax purposes, you are showing a loss, and that paper loss can offset real income. Some real estate investors, with the right structure, can show hundreds of thousands of dollars in income and legally owe zero in federal taxes because depreciation and other real estate deductions wipe out that income on paper. This is not a conspiracy. It is a real estate tax strategy used by millions of investors. Strategy 5. Retirement accounts are government-approved tax vaults. This one is available to almost everyone, and yet most people barely use it. When you contribute to a traditional 401k, a traditional IRA, a SEP-IRA, or a solo 401k, especially if you are self-employed, you are moving money out of your taxable income and into a protected account where it grows tax-deferred. If you are a business owner using a solo 401k, you can contribute up to $69,000 per year as of 2024. That is $69,000 that does not show up as taxable income for the year you contribute it. Combined with depreciation from real estate and deductions from a business entity, a high-income earner can legally reduce their taxable income by hundreds of thousands of dollars every single year without anything shady happening. The government built this into the code to encourage retirement savings and long-term investing. Your job is to use it. Here is the bottom line. The wealth gap in this country is not just about who earns more. It is about who understands how money is structured, taxed, and protected. 5 strategies. Entity structure. Business deductions. Capital gains versus income. Real estate depreciation. And tax-advantaged retirement accounts. None of these are secrets. They are in the tax code. They are taught in business schools. They are used by accountants for clients who can afford them. But now, you know them too. The system rewards structure, and structure can be learned. If this was valuable, subscribe. Share it with someone who is still working hard without working smart. And drop a comment below. Which strategy are you starting with?